Thank you for tuning in to the Mind Your Business Show. I am your host, Tony Calloway, the Private Money Godfather, and we appreciate the fact that you tuned into the show that's going to help you to grow your business and real estate investing. As we always say here, if you're going to go into business and stay in business, you've got to mind your business. And today we'll be talking about raising money for your business, and we're going to be right back, and we'll see you then. Hey, welcome back. We're so delighted to have you viewing the Mind Your Business Show. Again, Tony Calloway, the Private Money Godfather. And today's topic is raising money for your business. See, everybody has dreams, okay? And I believe that two dreams that everybody has is they want to invest in real estate and they want to start a business. And we know that it's going to take capital. It's going to take money to do those things. So today's episode of the Mind Your Business Show is raising money for your business so that you can make that dream become a reality in your life. Now, our sponsor is the Private Money Syndicate. And the Private Money Syndicate's motto is your dreams powered by private money. And you can reach us at 706-888-3719 and go to privatemoneysyndicate.com. If you'd like to get a copy of the presentation today, all you have to do is just reach out and we'll be glad to send you the PowerPoints. Just need your email and your name. But again, we want to help you to understand how you can capitalize your dreams. And that's what we do here at the Private Money Syndicate. So let's get started. As it says, it takes money to start a business. All right, and there are three sources of money, and most people have never thought about, okay, they just kind of go into business. Maybe they had some kind of business plan. Maybe they just kind of, flying by the seat of their pants. But it's really important to understand the types of capital and the impact that those have on your business. So here they are. The first is earned income. All right, earned income is money that you make. Second is debt, which is money you borrow, and equity. So as we consider these, it's important to think about from the standpoint of, all right, if we have different sources of capital, which one can I have? Which one should I use? What are the pros and cons? So I want to step you through these so that as you go about the process of thinking about how you're going to go in business and stay in business, you've got to think these things through because they do have an impact. First, you got to consider access. All right, access means how easy is it going to be for me to get this money? What am I going to have to do to get it, qualify for it, entice other people to get involved with me to share their capital with me? The second point is financial risk. Now, financial risk, there are a variety of different types, but the bottom line is the business going to perform such that it's going to have various opportunities to make money or lose money? And so how do I navigate those waters in order to be successful and put that capital to use in growing the business, making a profit, employing people, all the things that businesses do. Control. Now, this is one area that a lot of people don't think about is, okay, if I get somebody else's money involved in my business, is that going to allow me to operate the way I want to, do the things, or am I going to have to share and get authorizations and approvals from other people? And then going back to risk, if I fail to be able to service the debt, make payments, is somebody going to be able to come take my assets and things like that? So understanding the effect of control as it relates to the different sources of capital is something that you really need to be aware of. And the one that oftentimes people think about, what is the money going to cost me? Not too many people are giving away free money. Of course, during COVID, the government was doing a lot of that. But hey, we're talking about growing a business here. So there's always a cost of capital that has to be considered. So what I'm going to do over the next little bit is we're just going to walk through these different sources of capital. We're going to talk about them in terms of these 4 points and let you understand the differences, because whether it's one or the other or some combination, it's important for you as an entrepreneur or someone who wants to get into the real estate investing space that you understand capital from a bit more developed point of view than just thinking I need money, which I'm sure you think, hey, that's what most people think, but there's a lot of important things that I want to help you to think about today. All right, so again, the 3 sources of capital, we have your money, earned income. We've got somebody else's money that you borrowed, which is debt. But then there are people who want to invest in your business, which makes them equity investors, where there's a different dynamic associated with that versus debt. So again, let's look at the pros and cons related to each one of these. Cash flow using your money. Now, as you can see here, it is the easiest one for people to get access to. All right, because guess what? It's yours, okay? You already have it, or you're making it on a month-to-month basis, or whatever the case may be, but you're in control of the access to that capital. Now, the risk is, and this is one of the challenges for a lot of startup entrepreneurs, is they don't have adequate liquidity, which means they don't necessarily have enough money to fully flesh out the business. One of the things I often say to people is, don't build a bridge halfway across the river, because all that was put into that effort is still not getting you to where you want to go. And because a lot of people bootstrap their business idea because they haven't necessarily gone through and thought about all it's going to take, they wind up running out of money, or they shortchange the development process of the business and it fails, as unsuccessful. Let me give you an example that's going to make this absolutely clear. Let's say that you're going to make a chocolate cake, okay? Now, I am not somebody who bakes or cooks, but I do have some rough idea because I've eaten plenty of them, all right? So let's say we're going to need flour, all right? We're going to need sugar. We're going to need eggs. We're going to need butter, and I guess we're going to need chocolate to be the flavoring. And it's going to take a certain amount of those ingredients in order for you to actually put it into a mixing bowl, which you need the mixing bowl, you need the mixer, and then you need the pans, and then you need the oven. You need all of those things, all those ingredients, and you need all those elements to be able to produce a chocolate cake, right? Well, think of someone starting a business. If they don't think through all the things that are going to be necessary and what it's going to take in terms of resources and assets to be able to, get all those things under their control, to be able to use to make the cake, to build the business. What if you made a cake and you didn't have the eggs? Not going to be a cake, right? What if you had a cake and you didn't have an oven to cook it in? Okay, after you put all the ingredients together. So you get the point. So when we talk about the financial risk, the inadequate liquidity, the most important thing I can challenge anybody to do as they think about developing a business idea is to really think through what resources am I going to need. And if we're talking about the cash flow, using your own money, making sure that you have enough of it so that you can do it and do it sufficiently to be able to give the business a chance to not only start, but to continue toward profitability. So that financial risk, that inadequate liquidity, is a really big problem when it comes to using your own money. The next point is control. And as you can see here, you have 100% control because, going back to the first point, it's your money. So you don't have to ask anybody. You don't have to have any influences on how you're able to operate. Now, that can be good and it cannot be so good, because if you're left to your own devices, sometimes it's good to have some other opinions, some advisors, but the fact remains that you're in 100% control. And the last point here, cost of capital, well, you don't have to pay anything for money that's already yours. Now, there is a thing that I would say called opportunity cost, and that is for the money that you put into your business, then, okay, what else may I have forsaken in terms of that money being put to some other use? One example is people might take money out of their retirement account or other savings that they put toward a business. And if the business is not successful, then obviously it jeopardizes those plans that they had for that capital otherwise. But now nobody goes in business planning to fail. Okay, the problem is a lot of people fail to plan. So part of our reason for being here today is to help you to understand how to do that as it relates to the aspect of capital always being one of the ingredients in any business, of which there are four. And let me go ahead and make those. There's land, which is where the business is going to operate, even if it's out of your home. All right, there's labor, and the labor might just be you, or you might hire employees. Then there's raw material. Whatever the business does, even if it's a service business, you have inputs like you might have paper and you might have computers and so forth. But if you sell a product, then you obviously have to have the product, which is your material, and then capital. So land, labor, raw material, and capital. And today we're focused on the capital. And the very first source of capital is cash flow, and that is using your money. Second, somebody else's money. Now, we've all borrowed money from somebody, okay? All right, but now here we're talking about borrowing money for the purpose of going into and developing a business enterprise. So I'm going to make the assumption, being that I made the point already, that you're going to have to plan through and think of what all resources you're going to need for the business. But here's an important thing. Generally speaking, if you're borrowing money from some institution, then they're going to help you think of all the things that are going to be attributes that are going to be important to your business being successful, because they want to assess their risk, all right? Because again, they're going to look at these three factors, the three C's that are your access points to capital: credit, cash flow, and collateral. The three C's. All right, so let's talk about credit. Everybody's heard of FICO. That stands for Fair Isaacson Company. FICO, FICO. I don't know where FICO came from, but everybody has a score, a FICO score, whether it's high or medium or low. The fact remains that that is an assessment of how you've managed other people's money that was loaned to you over time. And there's several different aspects related to credit, not just that your payment history, how much debt you have outstanding, how much of different types of debt you have. You have unsecured debt like credit cards, and then you might have secured debt like cars that are, the collateral, or a home mortgage where the home is the collateral for the loan. But again, all those things go into forming your credit score, and I would encourage everybody to not only monitor that credit score, but endeavor to get your credit score into the 700s, because it makes a big difference in a lot of areas of your life, not just gaining access to capital for business purposes. The second is cash flow. Now, we talked about cash flow in the previous point, with it being the resource that you would use to fund your own business startup. But here we're talking about cash flow in that the lender is going to look at your ability to service the debt. Do you have enough income adequate for you to make payments? And I want to give you an example of something that lenders think about, lenders look at, so you can kind of look at it from a common sense point. All right, let's just say that I came to you and I said, hey, I want to borrow $1,000. And you say, okay, I'll loan it to you. And I said, well, I'll pay you back $200 a month, which means I pay it back over 5 months. And if I was going to throw in a sixth one for the interest, okay, so that'd be that would be what, $1,200 for the $1,000 I borrowed. And you say, well, Tony, before I loan you this money, let me see your bank statements. And I say, okay, here's my bank statement. Now you look at my bank statement, you see what came in, and then you saw what went out, and then you see that balance carried forward, and you see at the end of the month I had $500 left over. And so if you looked at 3 months in a row and you say on average those 3 months I had $500 left over at the end of the month, you say, okay, now I see where you can take a $200 payment out and pay me back. But now if you looked at my bank statements and all you saw was a negative or you saw $10 left over at the end of the month or what have you, then where am I going to come up with $200 to make payments with? So just on a very simplistic point, you see where I'm going with that. The lender is going to look at your capacity to service the debt. So the income that you're bringing in has got to pay all the things you've been paying, but now you're making another obligation. And even though the intention is to put this money to use to make more money with the business, the lenders are always what they call backward looking. Okay, they look at your history. They might look at your plan, but they're going to do their basic underwriting based on what you've done in the past, the records from the past. And another thing I tell people is that when it comes to borrowing money, it's just like going to court. Okay, you cannot convict without evidence. Now, anybody can say whatever they want to, but when they look at the evidence, which in this case we're talking about bank statements, in this case we're talking about your credit score, that's what you've done in the past, and that's what you'll be approved on or denied on, which again is the evidence. Now, the last point as it relates to the 3 C's is collateral. Now, collateral is if you're borrowing money that is going to be buying some type of product, or is going to be buying some type of property, or it's going to be buying some type of equipment, then that is something that the lender will put, I'll call it a lien or mortgage on, in that if you do not pay it back, according to the terms of the agreement, they'll take it back, okay? Now, the fact of the matter is this: they don't want your house, they don't want your building, they don't want the leased car, they don't want, if you leased an industrial copy, they don't want it back. But they want to use that as incentive and motivation for you to pay them, because this is what they call capital equipment. All right, that equipment is something that you're using or intending to use in the business to make money toward making a profit with, and obviously the business goes away if you don't have that. And in the case of, say, real estate, if someone had a rental property that had a mortgage and you didn't pay the mortgage, then they take the real estate back and foreclose is what they call it in the real estate space. Then, you can't collect rent anymore. You don't have the tenant. In business, I gave you the example of, I have a lot of clients who lease trucks. They're in the transportation business. Well, that truck, whether it's leased or whether they have a loan against it, if they don't service the debt, then they're out of the trucking business if that truck gets taken back. Now, it's important to understand that when it comes to collateral, the lender wants to make sure that the collateral is sufficient. That is, if they're going to loan you $100,000, they want to make sure that what it is that you're going to put that $100,000 into is worth at least or more than $100,000. So going back to a 18-wheeler, let's say the 18-wheeler is $120,000, and they're going to loan you 100, but now you're going to have to put 20,000 down. Okay, so your risk is your down payment. The asset's worth 100,000, they're 120,000, they're loaning you 100. So if you don't pay, you lose your 20 and they get their truck back. Now, understand, they don't want the truck. They want you to make the payments, but collateral's got to be sufficient. Now, let's say you were buying a used truck that's only worth $50,000. They're not going to loan you $100,000 on it, okay? Because it's insufficient collateral. So those 3 C's are really important. Your credit, that's the history and how you've managed other people's money. Cash flow, showing that you have enough revenue or income coming in after other expenses to be able to service the debt, and collateral. The collateral is sufficient to be able to motivate you to make good on the terms of the agreement, and of course, if they have to take it back, which they don't want to do, it's going to obviously give them an opportunity to sell it at a discount, get rid of it quickly, and get their money back. Now, the second point here is financial risk. Now, the obvious financial risk we're talking about in terms of debt is you got to pay the debt repayment. And I just made the comments earlier that the lender is going to see if you have the capacity, and they're going to see if your integrity and character in the past represents the fact that you're going to make that debt repayment. Now, to the business, that's money that's going out. Now, granted, if you borrow $100 and use that $100 to make $200, and then you're only going to pay $10 of that extra $100, then that means you made a $90 profit. Then that makes all the sense in the world. A lot of people, especially if you listen to consumer finance people like, say, Dave Ramsey or Susie Orman, they say debt's bad, debt's bad, debt's bad. Debt is not bad, and debt in business is how businesses operate. Amazon, Google, all these multi-billion-dollar companies, if you look at their balance sheet, they have millions upon billions of dollars of debt because they know how to make money with other people's money. You're only servicing the debt, but you have full control of someone else's capital to put to work in your business. However, there's a risk that if something disrupts the business and the cash flow is diminished or interrupted completely, that you can't service debt, then that's a risk, okay, because things can kind of go south quickly. Now, let's talk about control. Now, here it says you have 100% control unless you default. I'll just give the simplest example in the world. We'll go back to the truck where you purchased it, you paid $20,000 down, the truck's worth $120,000, the lender loans you $100,000. Well, you have complete control of that truck. You can drive it all over the country. If it can break down on the side of the road, if you don't fix it, as long as they get their payments every month, they don't care. All right. However, in the event that you default, then they're going to come get the truck. So you can kind of go from 100% control to none at all, but that's only in the case of default. So one of the good things about debt is that you don't, quote unquote, get anybody else mixed up and tangled up in your business. When you're using debt, you do have 100% control. And the last point here is cost of capital, and the cost of capital is whatever interest is part of the loan agreement. Now, granted, typically speaking, the lowest interest is going to be less expensive than the most expensive interest. I will throw in something when it comes into examining the effect of this notion and understanding that interest is cheaper, is you got to look at the effect of cash flow. So let's just say that you borrowed $1,000 and your business is making $1,500. Okay, keep the math simple. If somebody says, I'll give you a 5% loan, but your payment is that you got to pay it all back in 1 month, then you can't necessarily do that because you're only making $500, so you couldn't take that and pay the loan back. All right, now if they say we'll give you a 20% interest loan, but you only got to pay me $50 a month, then from a cash flow point of view, over the time it's going to take you to pay it back, yes, you would have paid more, but you would have been able to use that money and make money on it, and it fits within the cash flow. So it's important, in addition to understanding the interest rate associated with a loan, is you got to understand what the terms are, which means we would take the interest with the principal and divide it up over however many months they're going to have you pay it back. What are those payments going to be, and how's that fit in with your financial profile for your business? So your second point here is borrow money as another means of capitalizing your business. Now let's look at the third one. Now, a lot of people talk about getting investors, and as it says here, equity is investors or partners' money. And again, access has a multitude of challenges. So if I came to you with my brilliant business idea, let's say I want to open up a restaurant, and you know I can cook good, okay, but see, most people, a lot of people want to open restaurants, but restaurants are one of the most challenging businesses because not only do you have to cook, you also have to get customers in, you have to order inventory, and you have to deal with all the dynamics of running a business where the margins tend to be relatively small. So I don't like that idea, so I don't want to invest in it. So you go to 100 other people and you finally find somebody who wants to invest in your business. And so from the standpoint that it might take a long time, or it might take some effort to get people involved in becoming partners or equity partners. Now, from the standpoint that the good thing about that is, I tell people having other people involved in the business can also give you the resources that they bring in addition to money, but I'll get to that in another point. It's just that you've got to find people who want to be partners. We'll talk about some of the ways those efforts are actually been made easier with technology. But now when it comes to the financial risk is operating the business, all right? So to the extent I just gave the example of the restaurant, let's say you've got the best, barbecue restaurant in the area, okay? So from the standpoint that, you know, as a startup restaurant, the first thing you got to invest in all your tables and chairs, and got to get the place set up, your commercial kitchen and all that stuff. You have a lot of overhead going in, and then you have your grand opening, and you got to get people in the door. You got to get enough people in the door, ordered enough and selling enough that you start generating enough revenue to make a profit. All right, so to the extent that if any of that doesn't happen, then obviously there is risk associated with operations that could cause the business to fail. And obviously successful operations allow the business to succeed. Control, as it says, is shared. And to the extent that you might have a lot more control if you have silent partners, which a silent partner is somebody who does not get involved in the day-to-day operations of the business. They're not trying to tell you what they think about this or think about that. They're pretty much just a financial partner. But now if you have other partners who are not silent partners, then because they have capital invested in the business, then, you know, they've got a say. Now, whether you like it or not, it was your business idea. It's just that you needed their money. And here's some of the challenges with small businesses, especially when they start up on an entrepreneurial basis. The partners don't know much about the business. Now, they might understand it from a consumer point of view. They might not understand it from an operational point of view. To the point that there's the other side of that. Maybe you have a partner, and I recommend this oftentimes in real estate, where maybe one of the partners has managed real estate properties for maybe another partner is a contractor, a commercial contractor, or a general contractor who can make sure that the renovations and things get done. So oftentimes being able to bring other people together as part of you raising the capital, because now they have skin in the game along with you, can be a positive or it can be a negative. So here's the point to you. Be very mindful of who becomes an equity investor in your business. You being conscious of what your strengths and weaknesses are and the circumstances where somebody's money, along with other connections they might have connections to a particular vendor, or they might have connections to a big client that you guys might be able to come together with. In fact, I've got a client who was trying to raise capital, and one of the parties that we were looking to bring into the relationship, they have a personal relationship with one of the senior executives at Tyson's, okay? And this is a HR company that hires people to work in chicken processing plants, all right? And so the opportunity is to get a contract with Tyson's to help make sure they have adequate employees. May or may not work out, but here's the point. That would be somebody you would definitely want to have as a partner, from the standpoint that if the other rules didn't make them take over your business, then that's an issue. And that'll be the last point I want to say about control being shared. When you have equity partners, you want to maintain control if that's your desire. You want to have 51% ownership. You want to have, or at least 51% control, because otherwise somebody can take your business or your idea and they can take it over. All right? So just saying. All right? So just be understanding that there are a lot of things to think about when it comes to equity partners. I'm not saying it's good or bad. It's just that you need to do it intelligently. And the last point here is cost of capital. Now, it says they can range from, none to highest. And from the standpoint none, if the business fails, everybody had capital at risk, so it's all lost. You don't owe anybody anything back. The highest cost is, let's just say you bring in a 50-50 partner and you're going to split the profits 50-50, then they're getting 50% of everything forever, okay? Whereas if you had borrowed the same money, had to pay 10% interest on it, out of your profits, you would only been paying 10%, and you keep 90 versus now you got to pay half. And then when the loan was paid off, guess what? No more payments. So being very careful and conscious about the cost of capital when it comes to the partners, you need to take all those things I talked about, kind of wrap them into your understanding. If that's an avenue that you want to take, then I'm just saying these are things that I would advise you to be conscious of. All right. Now, the last major thing I want to touch base on is public offerings or private capitalization. Now, when it comes to public offerings, nowadays we got crowdfunding as well as the initial public offering or IPO that everybody's heard about from the stock market. Now, crowdfunding, there are a number of websites, Start Engine's one, there are tons of them. You can just Google crowdfunding and find all the ones out there. But that's where a lot of people, whether it's debt or equity, can pool money through these platforms and they can fund your idea. You got to do a lot of prep to put the information together so that it can be available. But the fact of the matter is crowdfunding is very, very popular as a means for people to raise capital for businesses. Now, when you get big enough to do an IPO, hey, you're really in the big leagues, and hopefully you'll get there one day. Now, private sources are, as you see here, family and friends. VC stands for venture capital. PEF stands for private equity firms, which are, if you kind of think of crowdfunding as an institutional process, they say, hey, we want to take your business and we want to go out here and raise institutional money from insurance companies and things like that to fund the business. Private placements are pretty much people who have businesses and then they know a rich uncle over here or the guy who just happens to be wealthy and they want to invest in your business. Traditional lenders like banks and credit unions and so forth, and then non-traditional sources, the space where we work in the private money syndicate, are alternatives to any of those, where there are processes where individuals can pool money or directly place money into businesses through people like the Private Money Godfather, who would more than be glad to help you to identify an opportunity to have people involved in your business. So understand there's a difference between public and private capitalization, and these are the points. All right, so let's recap. All right, we talked today about the three sources of capital: your earned income, your debt, and equity. You control it, you borrow it from somebody, or you have a partner in business. We discussed the pros and cons as it relates to access to capital, the financial risk. We talked about the control and then the cost of capital. And then I just talked about public versus private capitalization. You got crowdfunding, you got IPOs, you got all those opportunities on the private side to have people come and put resources into your business. So that's what we learned today here on the Mind Your Business show. And I'm really excited. I hope that you will contact me, the Private Money Godfather, and give me a chance to work with you on any of these things we've discussed. And again, our sponsor for this episode is the Private Money Syndicate at 706-888-3719, or you can go to our website. You can learn a lot at privatemoneysyndicate.com. And if you'd like to get a copy of this PowerPoint that I've used for today's episode, I'd be more than happy to provide it. So as we're wrapping up, I'd like to tell you that we appreciate you tuning in. We'd like you to share the word about the Mind Your Business show. And who knows, if you're an entrepreneur or real estate investor, you might be one of our guests on the show. So reach out to us, give us your thoughts and ideas, and we'll see you on the next one. Thanks and take care.